Australian and global listed property were the best performing asset classes in 2015. Australian equities returned 2.6%, including dividends for the year, with the best performing sectors being consumer discretionary and utilities, and the worst performing sectors being materials and energy. Global equity returns were solid, up around 11.8% on an unhedged basis, but the fall in Australian dollar attributed around 8% to those returns. Emerging markets had a very tough year, down around 4.3%. 2016 has started off very poorly, and in fact, it's actually the worst start to any year in the history of markets. Some markets have now entered correction territory, down more than 10%, and others have actually entered bear market territory, down more than 20%. These sharp falls have really turned sentiment negative very quickly. Headlines such as those seen here have been plastered on the front pages of newspapers and have gained traction in the financial press. The most recent headline was made by Royal Bank of Scotland, which issued a sell everything signal to its clients, citing the potential for a large market decline in 2016. Predicting market movements is a very challenging, if not impossible task, and it's very easy to become negative when markets are falling. Whilst we agree that the macroeconomic risks are very high and volatility is likely to remain elevated for some time to come, there are still opportunities for active investors to generate good risk-adjusted returns. The difficulty lies in the fact that interest rates and government bond yields are at or near record lows. And this means that investors need to move even further out on the risk spectrum in order to generate good returns. The question on investors' minds is whether this is merely a bull market correction or whether it's the start of a new prolonged bear market. The market has been overdue for a meaningful correction for some time now, and corrections are healthy in the midst of long-term bull markets. Markets do not go up and down in straight lines. We're likely to see further stimulus come from Europe, Japan and China, and whilst the US is raising interest rates, we expect it to be very measured. As we head through 2016, investors need to avoid focusing on the short-term noise and continue to focus on long-term investment strategies. Markets are now a lot more compelling than what they were 3 months ago, and this provides investors with an opportunity. Global debt levels have increased significantly since 2007, with margin lending debt at record highs and government debt continuing to balloon. Asset class valuations are also expensive by historical measures, with record profit margins and lacklustre earnings growth making it very difficult for markets to rise from here. China is clearly slowing down, and the government's intervention in markets is causing a lot of volatility and uncertainty, and this is exacerbated within other emerging markets also. The unprecedented amount of central bank stimulus that we've seen over the recent years will have unintended consequences, and unfortunately, no one knows how those consequences will play out. We've been focused for some time now on the headwinds facing markets. Market sell-offs typically happen very quickly, so being reactionary is not recommended. Having a proactive approach that has inbuilt protection is how we go about managing client portfolios. Our absolute return strategies have performed very well in 2015 when markets have been stressed. And as we move through 2016, many of those absolute return type of strategies have gone a long way to protecting capital, and in some instances have even provided very strong positive returns. We continue to have a high conviction in our absolute return strategies, and we believe that these are best positioned to provide investors with the risk and return outcomes that they're looking for. Our investment approach has worked for investors in 2015, and we believe it will continue to work for investors in 2016. The focus is on providing strong risk-adjusted returns regardless of whether the market is rising or falling. And this goes a long way to protecting investment capital when markets are stressed, like we've seen over recent weeks. An absolute return strategy also increases investors' opportunity set outside of Australia, and most Australian investors are over-concentrated to Australia. And regardless of the market view, positive returns are obtainable using an absolute return approach. So whether there's blue sky ahead or clouds on the horizon, this is the way investors need to be thinking about portfolios going forward. Investors need to stop thinking about investing the traditional way. When all asset classes are expensive, it's very difficult to generate returns using this traditional investment approach. The current environment requires a focus on absolute return strategies that can provide positive returns regardless of whether markets are rising, falling or flat. And we believe that these strategies are well positioned as we move through 2016. If you'd like to discuss your investment portfolio in more detail or better understand the risk that you're taking within your investment portfolio, you should talk to your Morrow's advisor. We can tailor a solution to suit your objectives.